The stock market is in a no man's land. The Federal Reserve just acknowledged that we're going to go into a mild recession at the end of this year, and the latest CPI print just showed us that inflation fell from 6% in February down to 5% in March, showing us significant progress from where we were in the middle of last year. As you can see, after being up almost 0.75% in pre-market after the inflation data, S&P 500 is down now almost half a percentage point. And that performance, paired with the fact that the 2-year yield from the Treasury actually fell after the Fed meeting minutes came out at 2 p.m. Eastern Time, is raising a lot of concern around what exactly markets are trying to price in next, because clearly they don't care about interest rates anymore. How sticky is inflation going to be, and what do the Fed's own participants think about where interest rates and the economy will head next? Those questions are exactly what I want to address in this video. But as usual, guys, before we get into it, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. Now, when I say that the stock market does not care about interest rates, I am obviously exaggerating, because in the short term, price action can do anything, but in the medium term, interest rates have a significant effect on business performance, capital spending, and the consumer. And as you can see, after the March 22nd FOMC meeting, interest rate expectations for the Fed funds have actually fallen to 3.4% by June of 2024. This also prices in the idea that interest rates will start to be cut in August of this year. Now, whether or not you want to believe that number, I'll let that you to decide for yourself. According to Bloomberg, at least, the market is pricing in interest rate cuts, even though the Fed is saying themselves they expect to pause interest rate hikes first after the May meeting and then see where we go from there. But given how the Fed has been lagging performances in the market, I'd be surprised to see if they actually follow with their initial claim of pausing until the end of the year. Because as you can clearly see, CPI inflation is cooling down significantly. After being at 9.1% in June of 2022, we are now down to 5%. We have basically already hit a peak in inflation, and I think people are underestimating the importance of this. And although yes, the core CPI number is higher than CPI on a headline basis now because of the rapid decline, it is still nevertheless a good sign in the right direction, and it's going to play into the idea of markets potentially relaxing and the Fed at some point pausing rate hikes, because I think they see that they've done a lot of damage to the economic and credit situation in America, at least given just how prices have fallen in something like used cars, houses, and obviously stocks like banks. And this neatly brings us on to understanding what the Fed said in that March 22nd meeting, which obviously was right after when the banking crisis happened, and also after we got the somewhat hot inflation print of February. As you can see, for the first time in their meeting minutes, which is basically a summary of what happened during that meeting from all the Fed officials, they're now coining the idea of having a mild recession starting later this year, with a recovery over the subsequent 2 years. This is the ultimate sign of the Fed saying, hey, if the recession happens, we are going to take as much action as needed to recover from that as fast as possible. And not only that, but it was revealed that a lot of staff members actually considered pausing interest rate hikes in the March FOMC meeting. But they ended up deciding that because of the inflation situation, which is their top and number one priority, they would still go with a 25 basis point hike. And after the latest CPI report, where CPI came in at 5%, the market, according to Bloomberg, is now pricing in a 73% chance of a 25 basis point hike in the May meeting. And to be honest, that might actually make some sense. Because in the short term, even though fuel oil and gasoline prices have fallen considerably, there are some components of the CPI report that are still relatively sticky, and they are the ones that make the core CPI so high. Medicare, apparel, food away from home, and transportation, including public transportation and airfare, is up almost 14%, which in my opinion is unacceptable. And according to some of my research, I think a lot of these variables are driven by just one thing, and that is shelter and rent inflation, which, as you can see on a year-over-year basis, is still sitting at north of 9% and has indeed not hit an inflection point just yet. And well, why would it have such a big effect? Well, because the shelter inflation is 33% of what's counted for in the CPI, and it is the biggest part of most consumers' budget. As you can see, although good prices have come down with meat, poultry, dairy, and fruit and vegetables falling on a year-over-year basis, we are still seeing services inflation led by the labor market, and indeed rents still climb slightly. And guess what happens when rents are still high? Landlords make more money, and those who are invested in real estate assets become wealthier and preserve their cash. That allows them to spend more money on services and keeping their jobs because of their higher pricing power. This results in higher costs of electricity and in some cases higher costs of transportation. And because of this, there's no surprise to me that the Fed is going to continue to try to raise rates to scare the economy and make those rents start going down by increasing mortgage prices. And although it seems very grim in the short term, in the long term at least, this might not be as bad of a situation as many people make it out to be. Because keep in mind, folks, housing affordability in the United States is literally at an all-time low. And this means that offer prices for some of the most prestigious real estate markets in the US are going to start falling. That's going to result in lower values for households, and as a result get accompanied into CPI's shelter index, albeit with a 4-month lag. And don't forget that a big reason of people's wealth over 2020 and 2021, which was the performance of the stock market, is getting evaporated today. The venture capitalist and startup world is at an all-time low, and as you can see, the 495 other stocks in the S&P 500 actually went down in March of this year versus the top 5 of the S&P 500, which include Microsoft, Google, and Amazon, went up by almost 15%. If you've been destroyed in the stock market over the past couple of months, which I personally have because of my heavy exposure to small cap and more riskier assets, then you are not alone. And to understand why this might be happening, I don't think we need to look any further than the 10 to 3-month Treasury yield spread, which is hitting a historic low far below what we saw happen in the 1980s. This has particularly accelerated over the past month or so, even though inflation is coming down. The yield curve is predicting that in the next 3 months, interest rates are going to be much higher than where they're going to be in 10 years, which should typically be the opposite way around. And just guess why this might be happening. Well, because interest rates are now hitting a terminal level, and historically in the past couple of decades, every time that has happened has been followed by an economic drawdown. Whether or not we're going to see something like the global financial crisis or the tech and telecom bubble over the next few months, I'll leave that for another video. But just keep that in mind if you're using the short-term performance of the stock market as a metric for whether or not you made the right decision. In the short term, the stock market is a voting machine. In the long term, it is a weighing machine. As usual, guys, let me know your thoughts, and I'll catch you guys in the next one. Take care.